Hey everyone, how's it going? Can you hear me okay? I was having a lot of microphone problems earlier, so I just want to make sure everyone can hear me. So I'm gonna have to wait, make sure because of the delay. Hi James, hi Fazio, hi Lise. Are we good? Can you hear? Yes. Okay. Great. Thank you. Thank you for letting me know that. I tried recording those videos for everyone earlier, explaining what happened on Thinkorswim today, and I did it twice, and I spent over 10 minutes on both videos, and it just wasn't happening, I guess. So I'm glad you guys can hear me, and everything sounds good and okay. Did you guys see that, by the way? Or if you guys aren't on my Telegram channel, you should get on my Telegram channel. There's lots of good stuff there. But uh, did you guys see that and learn anything from it? Otherwise, in the future, I won't have to go in that much detail. Like I'll still help people and chase it down and find the reason, but I won't have to spend like all in all, I spent over half an hour just trying to get the information out. So hopefully that was useful information to everyone. These delays kill me. Hi, Nestor. Hey, Carmen. Hey, John. And Fazio. Thank you, Fazio. Thank you. Okay. All right, let's take a look at what happened. It was a little bit of a test today because I'm sure a lot of people would have not had the fortitude to stick with a lot of trades. If we look at what happened over here in the market, what we saw today was a very large range sideways chop. So that was a large range, high volatility, low or zero directionality. And that's what gets a lot of people because when you have a wide range and no directionality, well, it sort of does kind of look like we have direction at some points in the market. And so that people can get really confused and go, oh my God, we're going long. Oh my God, we're going short. And we really end up just chopping sideways. So a lot of people have actually, it's the most difficult market to trade for anyone, even for me, even for people who've been trading for a really long time. And you have to constantly remind yourself, high volatility, no direction, no catalyst. High volatility, no direction, no catalyst. Except today there were a lot of catalysts, right? They just kept sending us in different directions. So it was a challenging day for most people today. Today in the morning payout plan, the one where we had that trouble with the Thinkorswim, even I at the beginning was having troubles like, do I just tell them to stop out early? Do we just take the profit now? Do we just hang on to it? It can be hard. It can be easy to second guess yourself during times like these. So one way that I keep at it, the way that I remind myself is, I remind myself, hey, we have to trade the environment that we're in. So we need to properly identify the environment that we're in, and we need to adopt our trading for that environment. So I have to recognize that there's no directionality and not get fooled by this and start to want to trade breakouts, directional moves, bounces off of VWAPs, things like that. Those are all for trending days. So today we just had to stick to our guns and just keep non-directional. And the other thing that you do to remind yourself is that you just say, well, if I'm getting swung back and forth, if I'm getting jerked around, then one, I'm probably getting a little too emotionally involved. And number two, I should probably just not trade. That's actually the safer option for me, is to not trade. Because if you get emotionally involved, then you start to make mistakes and you think, oh, it has to do this or it'll come back in my favor. Those are the types of things that if once you start hearing those types of thoughts, or you go, I hope that this is going to happen, once you hear those types of thoughts in your head, it's time to step back, stay away from the market, just watch it, or not even watch it, just completely ignore it until you can get back into a mentality where, oh, it doesn't really matter. I'm just observing and I'm risked appropriately. So any trades that I have open, it's okay if they hit losses, or it's okay if they hit their stops, because I sized it appropriately to begin with, and all of it is within my plan. Even if the plan or circumstances are going towards my, oh, crap plan. Oh, this is not working in my favor plan. I still have a plan for that, and it's still okay. The other thing that you can do is understand the risk parameters of your trade. So I know not everyone is going to know or understand the trade that I was in, or the people who have followed me today were in, but I'll use it as an example, just as a backdrop. So this was not the trade that we're in, but it's similar to the trade that we're in. And what we see here is, let's just pretend that this was the trade that we were in. What we see here is today we close right here, right at the edge of this break-even zone. So actually it would have ended with a very small 2.4% loss. And let's just say that I'm looking at it when the market is at 635. And I go, oh, that represents an 11% loss. If my stop loss is all the way out at, let's say, 20%, I know that it can move all the way to 634.5 without me getting stopped out. And so if we're bouncing around 635, 636, I'm not going to be concerned that I'm going to hit my stop. I can sit and wait. I can be patient. Now, if we're going between 634.5 and 635, and we're like, oh, we're close to stopping out, we're close to stopping out, we're close to stopping out, it's okay. I planned for the event that we could get stopped out. I should be sized appropriately so that if I get stopped out, it doesn't matter. So at that point in time, if we're at 635 and we go down to 634.5 and I stop myself out, well, at that point in time, I have 9% to lose, an additional 9% to lose. I have the 11% to gain to break even, and then whatever my profit target is. Let's just say it's also 20%. So then I have 31% potential gain, because that 20% is still possible. That 20% didn't disappear. Actually, up to 64% was possible. And so at that point in time, I have an additional 9% to lose and 31% possibility to gain. That's better reward risk ratio at that point in time. So it's actually that at that particular point in time, it would be better for me to just wait it out. And if the market is down and I see that, I also know that we have defined a range. I'm not expecting a lot of volatility because all my major catalysts are already over for the day. And very early on, we defined a lower bound right here at 634.35. Okay, well then I know that, hey, we might go to 634.35. We might revisit it, maybe go through it a little bit, but chances are we're going to bounce from those levels. So the chances of me actually hitting my stop are very low. Now, if we happen to have a break-even point that was below 634.35 or 634, that would be even easier, because we go, oh, okay, well, most likely we're going to bounce off of these levels. We're in a volatile but non-directional day, so that most likely we won't even visit my break-even point. So then it becomes much easier to just hang on to it and just let the trade work out. And in this case, if it was this trade that we just saw you, okay, well, we would have ended the day with a minus 2.4%. Well, that's much better than a minus 9%, right? So it still would have worked out. Yeah, we still took a loss, but there's no point in taking that loss super early, and no point in locking in that 9% loss early in the day, rather than just wait it out, and we got a lot of that back, much closer to break even. Okay, so hopefully that makes sense. So it's a little bit of trader psychology, games that you play with yourself, because your mind will try to freak you out, and so you need to play a game against your mind so that you can stick to your plan and say, okay, well, or reevaluate. Hey, does it actually make sense? Maybe it doesn't make sense. Maybe the probability, we're so far down here that the probability, and maybe we weren't in a non-directional chop day. Maybe we were in a downtrending day, like yesterday. If we had done that analysis here, that was a downtrending day. It was a downtrending day that turned into sideways chop and a little bit of bullishness at the very last hour of the day. So if I'm here and I say that my stop price is over here, but we keep on trading down, then I definitely wanted to get stopped out yesterday. So you have to recognize the environment that you're in or that the market is in and what it's going to do in its trade. And yesterday we could have argued that this was an even bigger, large volatility range day, sideways trade. The difference is we don't get our bottom print until much later in the day. So it's a little bit harder to recognize that. But if you've been coming to the post-market review any day of the past week, you would have heard me say that we're in a sideways chop and we're probably not going to get any real direction until Jackson Hole. And if you look at this, you're like, Kane, that is downward movement. This is downward movement. But if you remember yesterday, we did the analysis and decided that this was kind of our sideways trading box. Okay. And if I can include this as well in that box. So actually it's been going on for quite some time. So if we define that as our sideways trading box, then you recognize that's easy, that's normal. And we don't expect to have huge movement from day to day without the catalyst or with a huge major catalyst coming on Friday versus the baby catalyst that we've had Monday through Thursday. Although a couple of them did have some potential to become big catalyst, but none of them were even close to the potential catalyst that Jackson Hole is going to be. So when you have one big outsized catalyst at the end of the week, you can bet that Wall Street, even if they get a directional catalyst during the week, they're still not going to allocate large amounts of money. They'll allocate some money. They're not going to allocate large amounts of money until you get to that big catalyst at the end of the week, which is Jackson Hole. So I'm not surprised that the EMA 20 held because of that, right? We tested it twice so far. I thought that we'd be a little bit less directionally and that we would test the EMA 8 through the rest of this week, but I was a little bit off, and we're testing the EMA 20 throughout until tomorrow, and we'll see what happens. All right, let's see what you guys are saying. Hi, Cosmic Spiral. Hi, John. Hi, Tim. Still getting to know Thinkorswim. Okay. Hi, Kay. Nestor totally agrees with me at some point during that time. I don't know exactly what point you agree with me, but thank you. Trade was 638, 639, 640. Yeah, the trade I showed you guys is slightly different than the trade we're actually in. That's okay. Let's see. What does the market want to hear from Powell? Okay, we'll go over that. A rate cut specifically, or just clarity on it. I got stopped and closed on toss. They told me to look at the mid price that will happen. Kirk, are you on my Telegram channel? I did I spent a lot of my morning chasing down exactly what happened and then writing to you guys exactly what happened. I made 2 videos, but they both had no sound. So if you want the real breakdown and explanation based on the data that I got from the folks over at Thinkorswim, and they didn't explain that to me. They gave me the data that I needed in order to analyze and break down exactly what happened. So none of those reps could piece exactly all of that together. They just got me the data that was relevant so I could figure out what happened. Although the guy who helped me was very, very helpful, and he actually had the explanation, but not the depth of exactly what happened that I gave you guys on the Telegram channel. So if you want to see what happened, then you can read it on the Telegram channel. And if you need well, I might as well give you guys the Telegram channel link or the link to the specific post. Okay. So I wrote so much that I had to span it over a few Telegram posts because Telegram does have a character limit. There you go. Oops. That's the wrong. Oops. How do I do this? Let me get that link. There you go. All right. Didn't do stop loss order. Don't do stop loss orders. Okay. Well, that is personally, I never do stop loss orders on options except on SPY. We got burned by it a little bit by Thinkorswim today, and actually, getting stopped out was the appropriate action according to the actual events that happened. But the fortunate thing is that point in the market was only visited for exactly 5 microseconds. So they just have incredibly fast tech over there. So you got burned by that a little bit if you're on Thinkorswim. I did saw that, but I got that before you did. Okay, you got what before? In any case, you got it. That's the important thing. Okay. I don't do stops, except for on SPY potential. So, and then a lot of the time, so because I personally manage a lot of accounts, if I have a SPY trade and I have a stop for it, then I will put in the stop, but I won't do it for any other option in the market at all. Not the liquid ETFs, specifically SPY, because even the other liquid ETFs are not nearly as liquid as SPY. The explanation, Kurt. Okay, great, thank you. Okay, so hopefully we're learning a little bit about the trading psychology, how to view, just make sure that we know what's happening in the environment that we're trading, and then we make our decisions based on that, which is actually what I emphasize all the time, not just on a 0 DTE or on an intraday basis. So why do we put on the trade? Well, why do we look at everything that we look at before we put on the trade? It's exactly that. It's understanding the market environment that we're in and making sure we're trading appropriately for that environment. It's just today we had an excellent microcosm of that intraday also. So, and you could really see the difference that it makes. Like if I wasn't aware of the environment that we're in, then I got chopped all over the place. I got head faked so many times during this market. And if I was aware, then maybe it was still a little bit tough for our psychology, but as long as we're able to keep bringing ourselves back to the perspective, then we won't make that mistake. All right, so for the people who didn't get stopped out on Thinkorswim because of that 5 microsecond phenomena that happened today, well, it worked out. The trade worked out perfectly, and you just had to not get faked out by all of this noise that we went through. Okay, so let's take a look at with all this noise, and actually we did end lower today than we did yesterday, so down 0.4%. That's normal. That's a normal move. It's not a big downside move. I can't really call it sideways trading at 0.4%, but it's pretty close to sideways trading. So yesterday I was showing you the Gamma software, the Gamma scanner, and opportunities that we were looking for or that we found using it. And so we found 2 day trading opportunities yesterday. Those were both profitable. And then I swung L3 Harris. So that was LHX. So let's just see how it did today. And this one truly did go sideways. So still a baby amount of profit in LHX. Let's see. Yeah, just like 2%. So noise at this point. But we'll see. We'll see. Let's see where the gamma pocket is. If that got shifted, because anything that formed the basis of my trade idea, if that changes significantly, it negates my trade idea. If it negates my trade idea, then my timing and my execution are now irrelevant. And so then I need to close the trade. I need to say, oh, the entire premise of this trade is no longer valid. And so I cannot hold on to this trade, because now everything I did to validate it, everything that I did to evaluate the probability of its success, everything that I did to calculate the reward risk ratio, the expectancy, my chances of profit, all of that goes out the window. And you might look at it, but Kane, look, technically it still looks like a good trade. I don't care. My trade was not based on the technicals. My trade was confirmed and timed based on the technicals, but it was not done based on the technicals. So anytime there's an invalidation of any of the pieces of the analysis I did in order to go into the trade, I am out. I'll just say I'm wrong. Maybe the trade still works out, but if it did work out, it was working out off of unknown probabilities. So one thing that I'm really big on teaching, I guess I haven't really said it in the post-market review before, is what is the difference between investing and gambling? Both are the activity of putting money at risk with the hope of, or the probability, the possibility of getting a return, a positive return back. So getting more money back than we put in. So those gambling, yeah, I put money hoping that I'll get my money back plus some. Investing or trading, I put in money and I hope that I get my money back plus some. The same activity. So what's the difference between the two? So gambling, I always tell people, is a type of investing, and trading is an activity that we do while we're investing. And in order to properly invest, in order to invest with a positive expectation that we're going to make money and that we're going to get our money back and then make some on top of it, there has to be a few criteria. The first is that we have to know and calculate all of the odds and expectancies, okay? And once one of my fundamental underlying trade ideas, or the assumptions that formed my trade idea, gets violated, I no longer know or have calculated my probabilities. I could go and recalculate my probabilities and my odds or my expectancies, but then I would have to say my trade is now based on a completely different set of assumptions, or at least a slightly different set of assumptions. And based on that set of assumptions, now I need to go and recalculate everything. Usually, if you break one, then you've sort of broken a lot of the other assumptions inside of your trade idea. So it's not worth doing it. So I might as well just go and find another trade where I know the expectancies, I know the data, rather than sit here and try to rescue and save this trade and be like, oh my God, I'm not willing to take a loss. Oh my God, I have a 90% win rate and it's going to go down to 88, or I have this 70% win rate, it's going to go down to 68. And then we get uncomfortable or egotistical about our win rate, but that's not the proper measure, right? The proper measure is over the period of time that I care about, over the quarter, over the 6 months, over the year. Am I profitable? That's what I should be caring about, not, oh my God, I won 80% of my trades. So we want to make sure that we're measuring ourselves properly and be able to take that loss and say, okay, my trade was invalidated, I'm done. So I want to know if anything violated the trade idea. And then if the timing still looks good, and if so, then we're going to hang on to the trade. I can't say we, say I am going to hang on to my trade, okay? Because none of you guys were, this number one, I didn't give a trade on this, and two, I wouldn't be, it wasn't a published trade idea anyways. So number one, what was this based on? It was based on, number one, the overall market is still in a uptrend. Number two, that we have a high probability because of this movement of this short-term trend reverting to the same direction as long-term trend. Number three, we had strong support from our gamma pocket below, and then a strong target for a gamma pocket above, and a structure in the gamma that suggested that we could continue to move upwards towards 300. Those were the underlying assumptions. So is SPY still in an uptrend? The answer is yes. We're holding at that EMA 20. We're still above the MA 50. So yes, so check mark right there. If I look at LHX, this is the long-term trend, which I'm using the MA 50 to help define. Is that still sloping upwards? Did it change direction at all? The answer is no. Short term, did it still revert to the long term, meaning that it was down and moved up, and is it still pointing up? And the answer is yes. Okay, so that assumption or that piece of my trade idea did not get violated. So now what I need to do is I need to go and look at the gamma structure of L3 Harris. So let's take a look at that and say, do I still have support down at 270? Do I still have a target at 280? Does it still have potential to move upward towards 300? My plan was to just hold it to 280 though. So really I don't need that last part where there's potential run up to 300. But it's nice to know that it's up there, and I could take off most of my trade and leave a runner on and potentially ride it up to 300, right? I still have to stick to my plan. I don't say, oh my God, this is this 300 up here, I'm going to just target that. I'm going to revise my target. If I'm going to revise my target, I need to revise my entire plan. I need to revisit all of my assumptions again. And then guess what? My probabilities change. The probabilities of moving up to 280 are very different than the probabilities of moving up to 300. Of course, my reward risk is also very different, right? So that the balance of those two likely means that I have an even better expectancy. But I need to do that work. I can't just randomly say, oh, I'm going to target 300, okay? If I do that, I no longer know the expectancies. And if I don't know the expectancies, if they're not known and calculated, but these are the criteria that I've set up for myself, they're not known and calculated, then I am gambling, okay? So I don't want to turn a great trade, a properly formed trade, into a gamble simply because I think there's more profit potential. I do need to go back and calculate and reevaluate and make sure that I know for sure that we have that potential to hit, or sorry, the expectancies are positive or even better for me to reach that 300, in which case I don't say that basically I revise my entire trading plan. It's not, I changed my target, which is what most people would say. I changed my target, I moved it up. It's not that casual, okay? It's, I changed my entire plan and I did all of the analysis and the work that I need to in order to change that entire plan, okay? So I just want to emphasize that part, is that how important your plan is. So let's go over here and take a look at LHX. Did it not? Didn't run. Oh, there we go. Okay, very nice. So LHX, do I still have that gamma pocket below holding us at 270, supporting us at 270? The answer is yes. Do I still have a nice big gamma pocket, the largest gamma pocket, at 280? The answer is yes. Do I have a reasonable gamma pocket at 290? The answer is yes. And do I have that gamma pocket up at 300 still? The answer is yes. So far that is all looking very good. And then the other thing I want to know though is, remember I designed this as a reasonably short-term trade. I thought that it would take maybe 1, maybe 2 weeks. So I want to just check the shorter term expirations as well. So I'm going to put in this Friday, the following Friday, and the following Friday. I just want to see that the structure is similar, that it doesn't completely change shape over here. And so in this case, when I do all three of these, the 270 grows a little bit bigger, and then the 280 becomes the second biggest. I still have 290 and 300. So overall, it is basically the same. Now, do I need to be concerned that the 270 is bigger than the 280 now that I got rid of it? It just depends on the actual magnitude. And right now, what it means is support, strong support right there. So for me, it doesn't matter too much. So I wouldn't really care about that. I can remove and say, well, let's remove that one, the latest one, and say this Friday and the following Friday, completely different story, right? So 280. So what that means to me is that hopefully we hit 280 by the end of next week. And then if we go to the following week, then maybe it hits that and it bounces back to 270. And then we have to reevaluate and see if it still has that potential of 300. But that's beyond the scope of my plan, because my trade was to simply exit at 280 or very close to 280. So all of that other stuff is irrelevant to me. So it doesn't matter that 2 weeks out, the 270 is bigger, because 1 week out, 280 is bigger. So the more likely path is that we're going to hit that 280 and then maybe revisit 270 before heading upwards. That all fits within my plan, and everything is looking great for this trade. Right, so today's tiny little sideways movement is not an issue for me. I still have at least a week and a half in my trade to hit my target, and that target isn't so far away that that is pie in the sky thinking. And how do I know that? Well, I've got a ATR of 3.84, and I'm trying to hit 280. Oh, that's the wrong one. I keep picking the wrong. There we go, 280. Okay, so my ATR is exactly, or my target is exactly, basically just barely one ATR away, 1.01. If it moves at average speed, it will take me 3 to 4 trade days to reach it. And before next Friday, there are 5, 6 trade days. So easy. It's definitely possible. If we get the market maker's participation, it should move faster than average. So 3 to 4 days would be considered kind of slow movement towards my target. But even if it takes that long to hit my target, even if it's even slower than average, and it takes all the way till next Friday to hit my target, then I'm still profitable, just not as profitable. The slower it goes, the less profitable I am in a single options trade. So everything about this is looking perfect. I have nothing to worry about in this trade, and I can hang on to it and just let it play out. And tomorrow I'll look at it and I'll evaluate it again. And if it goes up, then I know that I'm perfectly fine. I can end my analysis because everything else held. But, or unless, I'm sorry, I can't, sorry. I can't do that. I still have to look at the SPY to see if we're still in that uptrend, right? And then, but if we go up, then I know that this is still up, and I know that this still bounced and is still going up, so I don't have to re-evaluate that. And then the gamut structure, I won't worry too much about it. I'll take a quick look at it and see if that structure is still in place. All right, so that's how I go about managing the trade. So between yesterday and today, you got the full plan plus management plus exact details of how I go back and look and manage this trade. Okay, so we trade idea, then we have the timing, then we have the execution, and then we have the management. And so you got every piece of that, including all the minute detail of what management exactly means. Any questions about that? Is that helpful going through that? No comments since I started talking about it, so I'm going to assume that everyone was following along. Okay. All right. Let's take a look at that scanner and see. Okay, so looking at the scanner today is just an exercise because we have Jackson Hole tomorrow. We do not want to make any major decisions or investments before Jackson Hole. If you want to put on a little baby play trade, little gamble trade for tomorrow, you can do that, but just make sure it's just very, 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 very tiny piece of your portfolio so that if it goes to zero, if you lose all that money, it literally doesn't affect your account at all. You can do that and just recognize that's just for fun. That's not, we're not actually trading for our account at that point. There's no institution that is going to make a major trade, do anything other than what I just said. No institution is going to make anything other than a baby fun for fun gamble trade tomorrow until they see that Jackson Hole data. So any trade that I find this afternoon is we have to treat it like a gamble because Jackson Hole has the ability to completely wipe out any assumption or any trade idea that we make. So that means it can completely destroy any trading plan that we have. And therefore, I'm not going to put serious effort into any trading plan if it can just be wiped out like that. And I can't put any money to work if my entire plan can just be wiped out like that. So everything is just going to be treated lightheartedly with fun. And therefore, maybe I still want to do all that analysis. Maybe I don't. It's just a fun trade, right? It's just a little keep me amused while Powell's talking type of trade. Let's see. Thank you for a detailed explanation. You're welcome, Maggie. Good, John. Good. John and John and Tim. Okay. So let's take a look at the scanner. I did this scan, well, not too long before the market closed, and we came up with these results. I think we got some bugs to fix in the scanner. So I'm talking to the developers about that. But I'd rather work with this more limited set of 30 than all 500. Is it bad if we still have plays lingering into tomorrow? I'm referring to new plays, Stefan, but hopefully you planned for Jackson Hole in your other trades, meaning that you recognize that your plan could get wiped out because of Jackson Hole and that you're allocated appropriately, that if you took a full loss on it, it wouldn't hurt your account. Otherwise, the better play would have been to just close out your positions at the close of the session today. Okay, but if you still have open, I have open positions, but if every single one of those goes to zero, it's not really going to affect my accounts across all my accounts. None of them are going to be hugely affected by that. So you might, right, if you're in my morning payout plan, or if you're in my weekend trading club, that I did not issue trades today because of Jackson Hole, because of exactly this, because that tomorrow morning could completely negate the entire trade idea, and therefore I didn't send those out. And then I wasn't in position. My gamma pockets and my quant X trades got closed out very early in the week because we saw that volatility come in and that uncertainty come in with the Jackson Hole. I haven't put on any new trades. So we took a loss. We just not stopped ourselves out. What happened was the trade idea got negated because of the volatility and because of Jackson Hole coming up. And so we close out the trade. And the trades happen to be in loss at that point in time. Doesn't matter. I have zero ego about this. Okay, if it was wrong, if my plan is negated, it's negated. I cannot stay in that trade. Otherwise, I'm gambling and I'm telling my members to gamble. So if the trade is negated, it's negated. I send that out. Even though every time I send out a losing trade, some people get upset, and every time I send out a winning trade, still some people get upset. So I can't let that affect me. I can't be egotistical about it. So if it's time to close, it's time to close. But I personally do have a few positions. For example, I have LHX open. We just went through all of that analysis on LHX and saying, hey, it's still okay to stay into the trade. Jackson Hole could completely negate that trade. And if that happens, then I'll be out. It doesn't matter if Jackson Hole negates the trade to the upside or to the downside. If it hasn't hit my profit target, but it completely changes my underlying assumptions, although what could that be? Okay, what could that be? Well, if my trade, it's unlikely that my trade will stay positive if it negated the S&P trend, okay, to the upside. So it's probably not going to be that. It's not going to be any change of this short term or long term, because that would mean that the price moved downwards. And so that wouldn't be a negation to the positive side. So the only way that LHX could continue to move up and my trade ideas get negated is it changes the gamma structure without really affecting the price. So for example, LHX, do I still have that open? I don't have it open anymore. How do I get this back open? Hopefully it loads nice and quickly. This is a good discussion we're having today. I'm glad we're doing this. This is really, really important. What basic fundamental information. And this is what I believe is really lacking for most retail traders, is that they don't understand the fundamentals and basics. They don't understand having a trade idea, exactly what that means. They don't understand, they're not even know that you're supposed to have a trade idea. They don't understand exactly what timing means. They don't know exactly what execution means, and they definitely don't understand exactly what management means. So today I think is really good. I'm very, very pleased about this, and hopefully you guys are learning and getting a lot. So this is not loading, unfortunately. So, okay, right when I say that. Okay, so what could happen? Well, 280 could completely shrink and go all the way down to here. And that by itself, it would completely negate my trade idea. However, if 280 shrunk and then that exposure went into 300, then my trade idea would still be on. So if 280 shrinks, and maybe so does 300, or even if they stay the exact same way that they are, and 270 increases, let's just say 280 shrinks, it's now the size of 290, and 270 just shoots way bigger. That gamma structure negates my trade idea. That is not, if I saw that gamma structure and I was doing a new trade today, I would not enter the trade. Or I would enter the trade despite the gamma structure, and I would be operating off of a different set of assumptions. Okay, but this was a fundamental part of my assumptions, that we have this gamma pocket at 270 supporting us and this 280 gamma pocket acting as a magnet for our target. So if that disappears, it's possible that price still went up, but the Jackson Hole caused a complete shift in the risk structure inside of the market maker's positions. That negates my trade. That negates the reason why I believe that we're going to hit 280 fairly quickly in just a few days, maybe a week at the longest, or 2 weeks at the absolute longest, right? That's what formed my idea that LHX was going to be able to reach 280 within a few days or a week. So therefore it becomes negated. Okay? And so at that point in time, I could have maybe not reached my full profit target at 280, but the underlying assumptions are no longer the same, and therefore I would be out of that trade. Okay, so hopefully that was a good explanation. That's a good question, Stefan. Good question. For bro, do you use spider lines? I gotta start reading comments. I read comments. I'm just slow at it because I don't interrupt what I'm saying to read the comments. I don't know what spider lines are for bro. So the answer is no. I don't use spider lines. If I've never heard of it, then there's a really high chance that no large major institution uses it. And if you don't have large institution backing the trade or using that methodology, then that methodology will have very limited use, except maybe on small cap stocks. So this is what I was saying earlier. We have to recognize that the market that we're playing in. Who is the major player? Who's in control of that market? Whose playground are we playing in? If we're talking about large cap stocks, that's the institution's playing ground, especially the S&P 500. So if you're trying to apply tools that institutions do not use to the playground that the institutions dominate in, you're not going to get very far. But if you use tools that retail traders use in an area where retail traders dominate in, then they could be very helpful. I demonstrated that with like Fibonacci lines a couple weeks back. So I don't know what spider lines are. I highly doubt they'll be helpful in large cap stocks, especially S&P 500, but maybe they'll be useful in small cap stocks. So without knowing exactly what they are. But if spider lines is a code name for something that institutions actually use and do, then yeah, we'll go for it. So I'll have to hear your explanation. Crypto Face uses it. He's like Crypto Whale. He trades live, and spider lines is basically ray lines from specific dates. I would have to see it. Sounds like he's more of a short term, maybe like a day trader for bro. Is that correct? You can contact me anyone can contact me at kane@investpub.com. Okay. Yeah, I'll be happy to take a look at it and see what's going on over there. What forms gamma structure? Gamma structure is so the market maker does not get to choose their positions, unlike you and me. I get to choose that I want to go into LHX. I get to choose exactly which option that I want to use in order to express my view on LHX. And I bought a call. I bought a whatever, I don't remember. Let's see, I can look it up. It was a September 19th, 280 strike call, okay? I could have bought the 270, I could have bought the 300. I get to choose. The market maker doesn't get to choose. When I choose that I want to go into the 280, I'm long, say 10 calls. I force the market maker into being short 10 calls. So the market maker doesn't get to choose their positions. Because they don't get to choose their positions, their hope is to make money in the bid-ask spread. And they do. So I pay a premium in order to get into that call or those 10 calls. However, they didn't get to choose. So they are at risk directionally. They have directional risk. We have directional risk as well, but not the same way the market maker has directional risk, because we got to choose and they didn't. We have all this analysis behind us that suggests that a higher probability of it moving in one direction or the other. The market maker doesn't get to do that. So the second you go in a position, they have to hedge themselves. And the more at risk they are, the more they hedge themselves. If for example, I had chosen to express this using the 300 strike call, we are so far away from the 300 strike call, they're not going to go and 100% hedge themselves. That'd be really expensive. So it wouldn't make sense for them economically for their business model to hedge that 100%. They might hedge about 10 or 15% because of how far away it is. But if we get to 280, they're going to add to their hedges. If we get to 290, they're going to add to their hedges. And by the time we get to 300, they're going to be fully hedged. So that hedging activity is them buying the underlying stock or selling the underlying stock. And so they will start participating in the market. And if they're buying the stock, guess what? They're driving the price higher. And if they have to buy a lot of that stock, then they're really driving that price higher. So what forms gamma is all these other options buyers and sellers forcing their positions upon the market maker, and then the market maker, that creates risk for the market maker. That's what creates the gamma exposure, and then they're being forced to go and hedge all of that risk away. And so that's what creates the gamma structure. The meeting tomorrow will be live. Yes, it starts at 10 a.m. Eastern time. And it'll be broadcast, yes. Okay, let's see. Yeah, I look forward to it, bro. I look forward to seeing what you got. What tool should we use to track institutional positioning and order flow? I don't track institutional order flow. It's not super helpful because institutions do a lot more than just express an opinion. They buy, they sell. Actually, the vast majority of institutional flow is hedging activity, rebalancing their portfolios. So when I was a professional portfolio manager, I was at a $1.7 trillion firm. I was trading $200 billion a day. We spent at least 90% of our day, if not more, rebalancing our portfolios, just rebalancing. Because if you're a fund manager, you also have, not only is your risk constantly shifting with your positions, you have outflows and inflows that you don't have control over. There's going to be, if I have, I don't know, 1 million clients, a significant number of people, let's say 50,000 or 100,000 clients could be like, hey, I want to withdraw some money today. And then another 50 or 100,000 clients could say, hey, I want to add some money today. So you have all these inflows and outflows, your cash balance is constantly changing. And so your risk and your portfolio balance is constantly changing. And so you're spending a huge amount of your time just rebalancing your portfolios and make sure that everything is looking okay. So that creates a lot of order flow, and that order flow is meaningless. It is not the institution saying, I think LHX is going higher. I think LHX is going lower. I'm starting a buying campaign. I'm starting a selling campaign. So the large amount, the vast majority, even if you think that it's look, someone put $1 million bet, someone put a $10 million bet. Hey, guess what? If I'm trading $200 billion in a day, $10 million is nothing. I'm not placing a bet, okay? I am just rebalancing my portfolio. So a lot of people like to use the size, the magnitude of the order flow in order to give them a clue as to whether or not the institution is expressing a directional view. And to me, it's mostly noise. It's mostly noise. Every once in a while, I mean, there's not to say that you couldn't examine the orders and patterns and discern how likely it is to be a real expression of directional bias, or just randomness, rebalancing, and all of this. I'm sure there are guys who look and examine and analyze that data and find an edge in that. I do not. I don't have a methodology. I've never done that. I've never analyzed that data, so I don't use it because I have way too many other ways of analyzing data and getting an edge that I don't need to extend myself into that area. So I personally do not use order flow. I'm not saying that it's not possible and that it's not useful. It's just that you have to filter through a lot of noise in order to get useful information out of that. And I don't need to take the time and effort in order to do that because I have plenty of other ways that are much easier to get an edge in the markets. Okay. So it sounds like Gans fan, several expanding angles from central key starting point, okay. Yeah, if it's a GANs fan, then that is not institutional. And the reason why it's working on crypto or has worked on crypto is because institutions were not playing in crypto until very recently. So you may see, if it is a GANs fan or something similar, then you may see that particular methodology stop working very soon. Last week I went through an entire explanation how we were moving into, or maybe it was earlier this week, how we're moving into a new phase in the cryptocurrencies and how institutions are now beginning to play in cryptocurrencies. Once they're full force in cryptocurrencies, then a lot of these tools that people were using before, those are all retail trader tools, Fibonacci's and GAN fans and the Elliott waves and all of this. Those are all retail trader tools. They're going to stop working once institutions are the big boys in the cryptocurrency space. So you may have seen success from 2008 all the way until now. Whoever is using those methodologies, if they are not aware that we are entering into a new regime and that the big boys are taking over, the institutions are taking over the playground, then they will unfortunately have a rude awakening. Their old methodologies will stop working. I can promise you that. Yeah, because institutions don't do that. They have way too much money to play with those things. Those types of things, you cannot move $100 million using a Fibonacci. You can't move $100 million using a GANs fan or Elliott wave or anything like that. It's by the time if you're trying to hit certain levels, you would never get enough volume done before the market moved away from those levels. So that's why those tools are not useful to an institution. And so you're going to see those levels get violated all the time once once large institutions start playing. Okay. What do I want to hear from Powell tomorrow? That's a great question, and we'll end with that. And any luck today? I don't know what you're asking about, General Wealth Kingdom. You sent for, bro? I'll take a look at it tonight, and I'll give you an answer tomorrow. Okay. So picks are from indices. Okay, yeah, I'll go into detail. I'll research it tonight, and I'll let you know what I think tomorrow. What do I want to hear from Powell tomorrow? I want to hear that he's on board, that the data suggests that it is safe and good and right to have a rate cut, or it's moving in that direction since the decision is still almost a month away, that he's open to a rate cut in September, and that if the data continues to move in that direction, that the committee is prepared to continue those rate cuts, that we're going to go into a cycle of cuts instead of a one-off. So the market has priced in at this point in time, it has priced in basically a very high probability of us getting 3 rate cuts by September. Okay. Oh, we went down a little bit. Okay. So but still, that's still pretty high. And I said September, I think. I meant December. Okay. So if we hear anything that makes this go down to basically 0 and think that we're only get 2 or 3 rate cuts. So look at this. This went down to about 25%, and the market is sitting at the EMA 20. So if I lose that other 25%, we're probably heading all the way down to that MA 50. Okay. And then if for whatever reason, the market no longer believes that we could get 2 rate cuts, that we might only get 1 rate cut by the end of the year, we're breaking that MA 50. We might even break the MA 200 because that would drive a lot of negative sentimentality in the markets. All right. So basically what that would mean to the market is we don't have a Fed put anymore. The Fed isn't going to provide a bottom inside of this market. And so that would cause a lot of fear in the market, and then that would cause a sell-off. And so in order for the markets to stay bullish, we want some sort of indication that 3 rate cuts is still likely, the most likely scenario for the rest of 2025. Okay. All right, guys. want Trump to be hush hush after. That's going to unlikely, unfortunately. All right, good. Yeah. Do you think the acceleration in input output prices from flash composites PMI will factor into Powell's framing of the issue, or is that data too recent? I think he himself will update himself based on the flash composite, but whether or not that's going to figure into economic policy, or sorry, Fed policy, well, they still have an entire month to absorb all of that. So most likely that will be reflected. Yes, I do believe so. Okay, we're exactly on time. We did not get to look for new opportunities, but that's perfectly fine because Jackson Hole is likely to completely negate that anyways. We had some really great discussions about some really fundamental basics in trading that I really don't hear anyone else talking about, at least not explicitly. Sometimes they do talk about it, but they don't point it out to you that they're talking about it. So I'm very pleased. Hopefully you guys got a lot out of this session. We'll see what Jackson Hole brings for us tomorrow morning. Have a great rest of your day, and I will see you guys tomorrow afternoon. All right, bye everyone.